Peachtree Case A by Julia Amar. Question 1. The T-bond returns are independent from the economy because the T-bond is considered to be free of default risk. The Treasury Department is expected to always be able to come up with the money to meet its necessary payments. All Treasury obligations are of the highest quality because they are backed by the full faith and credit of the U.S. government. However, they are not completely risk-free. They face other types of risks such as interest risk, reinvestment risk, and inflation risk. Interest risk relates to the inverse relationship of the interest rates and bond prices. If interest rates go up, prices go down, and vice versa. The reinvestment risk refers to the option of reinvesting the returns received on the bond. If interest rates are low, the return of the reinvestment is going to be low as well. If inflation rises and exceeds the return of the bond, the investor is actually losing money since the value of the money invested is declining. This is known as the inflation risk. At maturity, the principal is worth less than when it was bought. The expected return of each security is calculated using a weighted average of the returns and their respective. Standard deviation and coefficient of variation measure volatility risk. The standard deviation measures how much the actual returns differ from the total expected return. The coefficient of variation measures how much volatility there is compared with the amount of return expected. The lower the ratio, the better the risk-return trade-off. The coefficient is a better tool to analyze the risk of a portfolio of many different investments because it is a relative measurement. When analyzing one investment alone, the standard deviation is a better tool because it is an absolute measurement. The standard deviation and coefficient of variations were calculated for all four securities. The T-bond is a risk-free investment. Therefore, it has a constant return and no volatility. For TICO, the standard deviation was 11.7% and the coefficient of variation was 0.87. For Goldhill, the standard deviation was 9.1% and the coefficient of variation was 1.03. For the S&P, the standard deviation was 16.4% and the coefficient of variation was 1.09. Based on the standard deviation, the best risky investment will be Goldhill since it shows the least amount of risk. Based on the coefficient of variation, the best alternative would be TICO since it shows the smaller ratio of risk to return, having the most return compared to its risk. The expected return on the portfolio is 11.15%. This is calculated by a weighted average of the returns and the weights of each stock on the portfolio. The standard deviation of the portfolio is 2.9% and the coefficient of variation is 0.26. When compared to TICO stock individually, the expected return on the portfolio is reduced by only 2.35% from 13.5 to 11.15. The risk is reduced by 8.8% from 11.7 to 2.9%. Also, the weighted average of the standard deviations of the two securities is calculated to be 10.4%. The portfolio standard deviation is only 2.9%. This shows that the risk is reduced substantially when the two securities are combined in the portfolio. The risk reduction is possible because of diversification. This means an attempt to decrease the risk of the investment to zero by investing in securities that perform differently in the markets. This way, when one security has negative returns, the investment is hedged because another security will be providing positive returns. The covariance of the two stocks is negative 0.932%, which gives a correlation of negative 0.87. This shows that there is a strong negative relationship between TICO and Goldhill. This is a perfect scenario to diversify one's investment. When the portfolio holds equal amounts of each stock, the expected return is 11.15% and the risk is 2.9%. When it holds 75% of TICO and 25% of Gold Hill, the expected return is 12.33% and the risk is 6.89%. This happens because TICO is riskier than Gold Hill and provides a higher risk but also the highest return. When the portfolio holds 25% TICO and 75% Gold Hill, the expected return is 9.98% and the risk is 4.48%. Because Gold Hill is safer, it provides a lower risk than the previous option, but with the lowest return out of all of the investments. To analyze the risk reduction effect, we need to analyze the correlation of TICO and the S&P 500. The correlation of the two securities is positive 1. This means that there is a perfect positive relationship between the return of TICO and the returns of the market. Therefore, it is impossible to reduce the volatility of the portfolio since both securities move exactly the same way. There will not be any risk reduction effect with this combination of stocks. The expected return of this portfolio is 14.25%. The standard deviation of the portfolio is 14.05%. Also, the weighted average of the standard deviations of the two individual securities is 14.05%. This proves that the lack of a risk reduction effect in this portfolio because the standard deviation of the portfolio is equal to the weighted average of the standard deviation of the two individual stocks. As more and more random stocks are added to the portfolio, its risk should decrease. This happens because all the stocks are not all perfectly positive correlating, making the diversification effect possible. The implication of this is that investors should hold well-diversified portfolios of stocks instead of holding a single stock portfolio. This way, investors can reduce the risk they face with the investment by eliminating the unsystematic risk of the stock. Portfolio effects do affect the way investors think about the riskiness of individual stocks. The total risk of an individual stock is important to investors holding single stock portfolios. Therefore, an investor holding a well-diversified portfolio will not be interested in the stock's total risk, but in the impact the stock has on the overall risk of the portfolio. Diversification does affect companies' cost of capital. Since this diversification reduces the risk of the portfolio, it will decrease the cost of capital of the company. This will decrease the entire WACC of the company. Total risk is the risk of an individual stock, which is composed by systematic and unsystematic risk. Systematic is also known as market risk. This is the portion of the securities risk that comes from movements of the market. Therefore, this risk cannot be eliminated through diversification. Unsystematic risk is also known as company-specific risk or diversifiable risk. This is a risk that can be eliminated through diversification. Lastly, the returns on the stock does not compensate for all the risk being taken. If they did, all investors in the market would attempt to buy the security, resulting in an increase of the price of the stock and a decrease on the return. Therefore, one simply cannot find a security with high returns enough to make up for its high risk. The line connecting all the scattered dots in the chart is called the trend line, and it's used to determine the correlation of the securities and the markets. The slope coefficient is estimated using the regression line. TICO has a slope of 0.7. Gold Hill has a slope of negative 0.38, and T-bond has a slope of 0 since it has no relations with the market. The slope of the regression line is known as beta of the security. Beta shows the correlated volatility of each security when compared to the market. It measures the portion of each security's risk that cannot be removed by diversification because of the correlation of their returns with the returns of the market. The error term is present every time that the regression model does not fully represent the true relationship between the two assets being analyzed. It measures the validity of the model. The required rate of return when beta is 0.6 is 12.2%, which lies on the security market line. The expected return calculated before is 13.5%, which lies above the line. Therefore, the security is underpriced and investors should buy it. When inflation rate increases by 3%, the adjusted risk-free rate is 11%. This gives a required return of 13.4%. When the market risk premium is 8% and the risk-free rate is back to 8%, the required rate of return is 12.8%. When beta equals to 1, the required rate of return is going to be equal to the return on the market, in this case, 15%. All these calculations were made using CAPM formula. The efficient market hypothesis implies that any new information on the market will be immediately incorporated in the new price of the stock. Because information is reflected in prices immediately, it is possible to argue that all stocks will be fairly priced, representing the underlying value of the security. Therefore, investors should only obtain a normal expected rate of return. This hypothesis is not applicable to real assets such as plant and equipment. Financial assets are priced based on the financial information of a company and the information about its expected performance in the future. Real assets are priced based on appraisal of the asset. Therefore, the hypothesis does not have much relevance regarding these assets because information does not affect their price. The AMH argues that financial decisions are irrelevant if markets are efficient. The theory implies that all securities are fairly priced. Therefore, all stocks lie on the security market line. This means that the NPV from buying or selling the security is always zero. In face of this reality, any corporate financial decision would be irrelevant because any change in the structure would result in the NPV equals to zero, which would not increase shareholders' wealth. Jake Taylor should consider this hypothesis in order to decide to add another person to his staff. This hypothesis argued that financial managers cannot randomly pick stocks to invest in. Also, not all stocks have the same expected returns. Some will perform better than others. Therefore, some analysis should be done in order to pick the best investment options. Based on this, it might be beneficial to add another person to his staff. If TICO is reducing its total amount of debt, this will decrease the risk of equity, decreasing its cost of equity. Also, the beta of a levered firm is always higher than the beta of an unlevered firm. Therefore, with less debt, beta will also be reduced. Since both the cost of equity and the stock's beta are lower, the required rate of return of the stock will also be lower.